I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 5 videos on swing trading examples. I'll begin with some examples using higher time frame charts, and then I'll move on talking about a bear swing trade. This is a 240-minute 4-hour chart of the euro versus the dollar, and you can see there's an obvious, very strong bull breakout. Whenever you get an extremely strong breakout and you're well above the bars to the left, there's about a 70% chance that you get some follow-through buying. Here the breakout lasted 3 bars. The odds are high the first reversal down will fail, and you'll get at least a small second leg up. This bar is unusually big, and the follow-through make the 3-bar breakout unusually big, and therefore it's unsustainable and climactic. Also, you can see that the bodies are getting smaller from here to here to here, and then followed by a bear bar. The bulls are running out of momentum. Also, you can see that there are tails on tops of all 3 bars, and bulls are taking profits at the highs of the bars. This means that you're probably going to get a 10-bar 2-leg pullback, TBTL pullback soon, probably a bull flag, and probably the bulls will buy for a reversal up. Remember, after a strong breakout like this, 70% chance you'll get at least some follow-through buying, and therefore bulls will bet that the reversal down will fail. Take a look at this reversal down. We have a bear bar, but it's followed by a bull bar. A bear bar followed by a bull bar. Bear bar followed by a bull doji. That is not how strong reversals look. The follow-through after every bear bar is terrible, and this is therefore more likely going to become a bull flag, and the bulls will get a breakout and trend resumption up. This is very different from a reversal where you had a bear bar, a second bear bar, third bear bar, 4 bear bars, or a reversal down with a huge pair of bear bars or 2 or 3 bear bars. This looks more like a bear leg in a trading range or a bear leg in a bull flag. I call it a wedge. You can say it's 4 pushes down, 3 pushes down. We have a bear bar and a bull bar. We have a bear bar and a bull bar. We have a bear bar and a bull bar after it. And then we have a 4th push down as well. It does not matter if you say this is a wedge and we get a failed breakout below a wedge. Whenever you have a wedge and a breakout below, 50% chance the breakout is going to fail and reverse up. 50% chance the breakout is going to be successful and you got to swing down. That's in general. Here, look at the context. The context here is that the probability is very high after this strong bull breakout that even if we break below this wedge, 3 pushes down, 1, 2, and 3, the market will reverse up. The breakout will fail, which it did. It pulled back to the moving average and it reversed up. Bulls will buy above the failed breakout bar, and now we have a reversal up and they have a pullback. They'll buy above that. Now we're starting to get a bull close, a strong bull close. They'll buy that as well. This very big bull bar pulled back here to this low and then resumed up. This sell-off tested that low, and therefore it's a double bottom. This is the neckline of the double bottom. The bulls are hoping that the market breaks above this neckline and rallies for a measured move up. It did not get that far up, but that is the hope for the bulls. No matter where you buy, if you buy any of these closes, if you buy the low of this bull bar, if you buy the reversal up here or any of these, the initial stop is way down here until after you get a strong breakout to a new high. Then you can raise your stop to below the most recent strong higher low. This is a major higher low. You only call it a major higher low after you get a series of strong bull bars and a breakout above the prior high. At that point, the bulls can raise their stop from here to here, because if it is a bull trend, it should not fall below the most recent major higher low. If it does, then it's probably not a bull trend anymore. It's then either a trading range or possibly even a bear trend. Some traders, when they look at a breakout like this, say, wow, I don't want to risk all the way down here, 300 pips, 400 pips. I cannot risk that much. However, they do want to take the trade, so they'll buy here. Maybe they'll put a stop below this low. I think that's too tight. However, they might put a stop slightly below a 50% retracement. This is the low, this is the high. Wherever the 50% move is, they might put a stop slightly below that 50% mark, thinking that the bulls will buy a 50% pullback. A spike, pullback, probably channel. So you expect 3 pushes up, 1, 2, and then 3. And the third push up has a smaller wedge. So it's a nested wedge. Small wedge, 1, 2, 3, inside of a bigger wedge, 1, 2, 3. That increases the chances that we're going to get at least a couple legs down, 1 pullback, 2. Usually the market tries to test the bottom of the initial wedge, the bottom of the first pullback, and then it usually evolves into a trading range. The bottom of the range is usually around the bottom of the wedge. Here's the wedge. First push, second push, third push. Sometimes it's a little bit below, sometimes it's a little bit above, but a spike pullback channel usually evolves into a trading range. Remember, market cycle, you get a strong breakout and then a channel and usually a trading range. It's a nested wedge. We have a big wedge, 1, 2, 3, and the third leg subdivided into a smaller wedge, 1, 2, 3. And nested patterns have a higher probability of leading to successful reversals. Traders will sell below the low of this bar, looking for a couple legs down, 1 pullback, 2. It's a fairly tight channel here. Probably not a major reversal, probably a bear leg in a trading range. For example, the entire bull channel, the wedge bull channel, might convert into a large trading range. This rally is fairly tight bull channel. The sell signal bar is weak. That also reduces the chances of a major reversal into a bear trend. This is a reasonably good location for a stop above the top of the nested wedge. We might get one more push up and then a reversal down, just like we had a wedge bull flag here. We had one more push down and a reversal up. It's very common when you have a wedge to get a breakout beyond the wedge and then a reversal. But this is a reasonable location for the stop above the top of the nested wedge. Some traders prefer a wider stop just in case it starts to go down and then goes up for one more small leg. If it does, it probably will not go beyond a measured move up based upon the height of this small wedge, and therefore they might put a stop above a measured move up, and they might even sell more higher, betting that a spike pullback channel should evolve into a trading range. If not here, then soon. Other traders prefer higher probability trades, and they'll wait to see if the market has a strong bear bar or a pair of bear bars. They'll sell closes here, or even better, here. Consecutive big bear bars. This is a sign that the bulls are giving up. All the bulls who bought through here at this point are now holding losing positions, and they know a spike in channel pattern typically evolves into a wedge. And once they see the strong bear breakout, they expect a second leg down, so they exit. The bears know that as well, so they're looking to sell. They'll sell a bear close, and they'll sell an attempt to reverse up. They'll sell above the high of this small pullback bar, betting that instead of a resumption of the bull trend, it'll form a lower high and we'll get at least a small second leg down. Fairly strong breakout. At this point, most traders would put their stop above the top of the nested wedge. At one point, this bar was a big bull trend bar, but by the time it closed, it was a bear doji bar. The bulls hoped that they were going to reverse this bear breakout. Instead, they got a lower high, and it led to a second leg down. Weak bears might exit, but their correct stop was above the top of the bear reversal. Strong bears are selling more, and that's what happened here. The market went up, and the strong bears saw it as an opportunity to sell at an even better price. They sold here, they sold here, they sold above this doji, and now they get to sell at an even higher price, and they took advantage of it, and they sold. And the bulls who did not exit during this reversal down see this as an opportunity to exit with a smaller loss, and they're selling as well. Wedge top, nested wedge top, strong bear breakout. The odds are there are sellers above these bars, and we'll get a lower high and a second leg down. Strong bears are relying on their stop above the top of the wedge. It's very common when you have a spike pullback channel, a spike in channel trend, for the market to get down about halfway and then enter a tight trading range. The bulls were hoping for a trend resumption up. They tried to get it, but it failed, and the bears are hoping that we'll get a second leg down, which is what usually happens. Because we're not collapsing, selling off strongly in a series of big bear bars, this tight trading range is a sign that the bears are not especially strong. And as a result, traders think that whatever sell-off we get will be a bear leg in a trading range, just like the bull channel was a bull leg in a trading range. And therefore, traders, for the most part, are scalping. They're expecting A small second leg down with buyers around the bottom of the wedge bull channel. Remember, spike pullback channel, probably a bull leg in a trading range. A bull leg in a trading range is usually followed by a bear leg in a trading range. And now we're down near the bottom of the range. Guess what should happen next? Well, you'd expect a bull leg in a trading range. You'd expect a bounce somewhere around the bottom of the range. Because of that, bears take profits near the lows and bulls begin to buy, especially if there are other signs of a bottom. Remember, this is a spike down, a bear breakout, and a pullback, and maybe we'll get a wedge bottom. So first push, second push, third push. So spike, pullback, bear channel, spike, pullback, bull channel. The wedge bull channel, we get a bear breakout. The wedge bear channel, we're probably going to get a bull breakout and maybe a test of the top of the pullback. So spike, pullback, and channel. So this general area is a reasonable magnet. Because of that, the bears will start to take profits on a reversal up, reversal up, reversal up, and now reversal up, 3 pushes down, 1, 2, and 3. The bears will take profits and aggressive bulls will begin to buy. It's also a big double bottom bull flag. Bull trend, pull back to a double bottom, here and here, double bottom bull flag, and bulls will look to buy a reversal up. The selling here is not very good. Doji, 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 doji. There's no urgency. There's no sense that the market has to go a lot lower. The bears are afraid to sell near the bottom of what is likely a trading range. And if the bears cannot go down, the market probably will turn up. The bulls will buy the reversal up, or they'll buy the pullback. Second entry buy, down, up, and down. A lot of bulls prefer the second entry buy because a lot of times the first entry fails and you get a strong bear breakout. However, if the attempt by the bears does not get very far and we get a second entry buy, the bulls will buy. Here we have an IOI, inside, outside, inside. Bulls will buy above that bar, looking for at least a couple legs up, maybe to the top of the channel, maybe here, maybe up here. It's reasonable in this case to put a stop right below this low. You have a double bottom, and you have a wedge bull flag, and you have a first entry up and then a second entry up. The bulls do not want the market to break below this low. If it does break below the low and then immediately reverses up, they'll buy again. Just like here we have a wedge bull flag, 3 pushes down, 1, 2, 3. It tried to reverse up. Instead, we got a bear breakout. Bulls buy the reversal up. Some bulls might want to use a wider stop. They see a lot of dojis here, and therefore they think it's a trading range, and they know that it could easily break a little bit more to the downside. The buy signal bar is small. If they buy above its high, their risk is small if they put the stop right below. And very often when you have a small signal bar, the buy triggers, the market falls below the buy signal bar, and then reverses up again. Therefore, some bulls, instead of putting their stop right below the low, will put it beyond some kind of a measured move down, maybe based on the height of this small double top, this small developing tight trading range. So that's the measured move down, and they'll put the stop just below. We have a wedge bottom. You'd expect at least a couple legs up. We have an attempt at a leg up here. The bears have a bear bar, so trying to get a wedge lower high, 1, 2, 3. The market triggered the short. It fell below that bear bar, but immediately went outside up on this bar. The bears tried to close the gap. They tried to get it to fall below the high of this bar, and they could not. Several bars in here, they tried to close that gap, and they could not. And then we got an outside up bar. We're probably going to get a measured move up from this gap. We have a bear flag, and we have a bull breakout above the bear flag, probably at least a second leg up, maybe a measuring gap from these lows to that gap to up here. Strong enough breakout for at least a small second leg up. Also, the bears triggered the short below the wedge bear flag. The bears were hoping on a bear channel, lower highs, lower lows. They wanted it to continue down. However, when they tried to reverse down, they triggered the short by falling below that bear bar. The bulls bought aggressively, and we got outside up. Usually, you're going to get at least a small second leg up. Three pushes up, three little bull bars, and then down. Three little bull bars, and then down. So three pushes this high, that high, that high. And it triggered because this bar fell below that bar and immediately went outside up. So we got a wedge lower high, triggering a short, and then immediately on the same bar, the market went outside up and hit the stop for the bears who did sell below that bar. They'll probably put their stop above the top of the wedge. The bears also see this as a head and shoulders top, left shoulder, head, right shoulder. Every time the market's in a trading range, there's always a bull case and a bear case. For the bears, it's a head and shoulders top, left shoulder, head, right shoulder. And for the bulls, it's a double bottom bull flag. Double bottom in a bull trend, expecting a bull breakout. Most of the time, the trading range continues. 40% of the time, the bears do get a major trend reversal. 40% of the time, the bulls eventually get a bull breakout. Most of the time, the market ends up continuing sideways indefinitely. Because it's a reasonable head and shoulders top, the bulls who bought for any reason here will exit. They're not expecting a strong bull trend. Also, look at these bars. Where are the consecutive big bull trend bars? There are none. You have consecutive bars, but they're not big. They have tails on top. And therefore, this rally is probably a bull leg in a trading range. And if it's a bull leg in a trading range, the bulls do not want to hold forever. They'll take relatively quick profits. Here we got a breakout, pullback, second leg up. They'll exit below a bear bar and get filled right here. I want to talk a little bit about a bear swing trade. Clearly a very strong bear trend. This is the euro versus the dollar on a weekly chart. When you're trading a higher time frame chart like this, a weekly or monthly chart, a trader is investing, not trading. But the same principles apply. A trader is looking to take profits in a day or two, or maybe a week or two. A day trader is looking to take profits that day. If you're trading a weekly or monthly chart and you're planning on holding on to the position for 10 or 20 bars, people typically do not use the word trading. They use the word investing. Look at this sell-off. We have a strong bear breakout here, another strong bear breakout here, and a third strong bear breakout here, testing the bottom of the channel. We have a series of sell climaxes here, here, and here. You can call it a parabolic wedge, 3 pushes down, 1, 2, 3, in a tight channel. That's my definition of a parabolic wedge, 3 pushes down in a very tight channel. A series of sell climaxes often leads to a reversal. Also, look at these two big bear bars. They're the biggest consecutive bear bars in the entire trend. This trend probably lasted about 50 bars, and now we're getting the strongest pair of bear bars 50 bars into a trend. Whenever you get the strongest breakout occurring 20 or more bars into a trend, that breakout is more likely a climactic end of the trend instead of a measuring gap and an acceleration of the trend. It's still sell the close. Traders are selling every strong bear close, bidding that the market will go lower, knowing that eventually they'll lose. However, after consecutive sell climaxes, a break below the bottom of a bear channel, the biggest pair of bear bars occurring 50 bars into the bear trend, you can only sell this if you can make quick decisions and scale in higher. There's too much risk that we're going to get to the top of this final sell climax. These two bear bars are part of a 3-bar sell climax. If we reverse, the first target is the top of the sell climax up here. Is this going to be a measuring gap from this close to that low, and then we fall far down for measured move? Or is it going to be an exhaustion gap? Will the market trade back above that low and fill the gap between that low and this close? Probably it's going to be an exhaustion gap. 60% chance we're going to trade above that low and get to the top of the sell climax up here. Minimum goal for the bulls, a couple legs up, probably lasting 10 bars or more. And they want to test resistance like the top of the sell climax or the moving average. And ultimately the top of the channel. I do not have the channel line drawn in, but you could draw a line from this high to that high. Channel is very tight. You would not need much of a rally to reach the top of the channel. You can see what happened. Typically what happens is the market goes a little bit above the top of the final sell climax, maybe a pip or two, and then it goes sideways. The bear channel is extremely tight. Even though it's a double bottom, it's a minor reversal. Chances are the best the bears get is a trading range, and that's what they got. And it lasted for many months. This is April. This is January. Remember, this is a weekly chart. Is this strong enough so that the bears will get a second leg down? Well, it might be, but it's also more likely an exhaustion gap. And this is the second leg down. Even though this low did not fall below that low, it met the minimum requirement of a second leg down after a strong bear breakout. What happened here was the bears who sold the close of every bar, were disappointed by this bar. They sold a little bit more higher, and they tried to get out break even around their first entry at that close. And you can see this got near it, but not all the way to it. And the bears started to buy back their shorts, and the bulls bought as well. Sell the closed bears who sold closes all the way down. They sold this close. The ones who did sell this close saw this big bull bar at the bottom of a channel. They're aware of a possible parabolic wedge. They're clearly disappointed. If they sell this close, it's better if they can sell more higher, maybe a 50% pullback in this breakout, looking to avoid a loss. They can avoid a loss by getting out at the midpoint between their two entries. If they sell here and sell more here, their midpoint is here. They can make a profit if they sell this low close and sell more higher, and then the market comes back to their original entry price. If it falls a little bit below their original entry price, they can get out break even on their first sell and then with a profit on their higher sell. This low did not fall below that close, and therefore the bears who scaled in were trapped. Ultimately, they gave up on this bar. This is a give-up bar, a bull breakout after a test of the close. The bears, disappointed by these three bull bars, placed limit orders to get out break even, or maybe a little bit higher than break even, just in case we get a sell-off that does not quite get down to their original entry price. And this little bull bar and this bull bar represent bears buying back shorts. The bulls have a good bull bar here, a tail on top. They have another bull bar here, no tail on top. They have a double bottom, a small double bottom, after a parabolic wedge. Bulls will buy above the high of this bar, and if the bears are still short, they'll exit. And both created this breakout. The context is good. You have a parabolic wedge, 3 pushes down, 1, 2, 3. You have the biggest pair of bear bars late in a bear trend. You have a decent bull bar here and a better bull bar here, no tail on top. Small double bottom. Odds are high we'll get at least a small second leg up to the top of the most recent sell climax. Because of that, bulls will buy on a stop above the high of this bull bar. It's a second reversal up. The market tried to reverse here and then is trying to reverse here as well. It should not fall below the low of this buy signal bar once the buy triggers, and therefore the bulls will put their stop just below that low. If you buy above the high of this bull bar, remember this is a weekly chart, your stop is 320 pips below. That is a lot of money, and if you're risking 320 pips, you have to trade a small position size. A reasonable good location to take partial profits is at the top of the most recent sell climax, which is also around the moving average. Some traders will simply take profits on the close of the big bull bar, because whenever you have a bear trend and then you get a big bull bar closing at or near the moving average, you'll have bears beginning to sell. And sometimes it'll lead to a resumption of the trend down. So it is okay to sell out of your longs on the close of a big bull trend bar that closes near the moving average. For the bears, we have a sell climax, a reversal up to the top of the sell climax, and it's a double top. It could be a double top bear flag. The market could fall below the neckline for a measured move down. Anytime you have a double top in a bear trend, it's a low too short. You get one reversal down and then a potential second reversal down. Also, it's a 20 gap bar sell. The market had not touched the moving average in about 40 or 50 bars. When it has not touched the average price in a long time, the bears who are willing to sell far below average will be very happy to sell if it gets back to the average price. And therefore, the first pullback to the moving average is usually a good selling opportunity. It's certainly a good location to take profits if you're long. I think this is a high probability buy setup, and therefore you only need a reward equal to your risk, your actual risk. The actual risk was from your entry price above the high of this bar, and if you looked at a daily chart, you would have seen that the pullback was only about 59 pips or so, and then the market resumed up. Therefore, your actual risk is only about 60 pips. And since the probability is high, 60% or more, that the market's going at least a little higher, you can exit with a profit equal to your actual risk, 60 ticks or so, knowing that you'll have a positive trader's equation. Here, if you did buy here and you exited up here, you made about 350 pips, which is many times greater than the actual risk, and it's in fact more than the initial risk. The initial risk is from your entry price to where you put your stop. That is a reasonable location to take profits. It's more than twice your actual risk. Experienced traders expect the reversal up, and they buy the close of this second or third bear bar, betting that it's going to be an exhaustion gap and that the market will rally back above the breakout point, this low, and in fact, at least a pip or so above the top of the most recent sell climax. So bulls will buy that bear close, betting that it is unsustainable, climactic, and likely to lead to at least a couple legs up. The bears tried to resume down again, but strong bulls will buy that close, betting that the sell the close bears who sold this close were disappointed by these three bars, and they're hoping to get back to break even where they can get out without a loss. The bulls know that, and when they see a strong bear close near that close, they'll buy. And in this case, enough bulls bought and enough bears bought so that we got a bounce, and it never reached that low close. Some traders will be concerned that the second leg down might fall below the bottom of the sell climax. Typically, it will not fall beyond a measured move down, and therefore some traders will put their stop just below the bottom of a measured move down, either from the height of these 2 bear bars or the height of these 3 bear bars, allowing for the possibility that it will fall below here, but not far, and then reverse up. One of the reasons why bulls buy these bear closes is because it's only a slightly lower probability that we'll get the reversal up, and the risk is much less, and the reward is greater. If you're buying lower, below the target, you have much more potential reward. For example, if you buy that close, your actual risk was only about 20 pips or so. The same with buying that close. I began this video with a discussion of swing trades in higher time frame charts, the 240-minute euro versus the dollar chart. And then in the second half, I talked about an example of how to manage a swing trade when the market's in a strong bear trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on swing trading.